Today's episode is brought to you by S&P Global Market Intelligence. Find insight at every data point with enhanced S&P Capital IQ Pro platform. It's the leading data solution for strategics and investors alike. Discover critical data sets, including coverage of over 54 million global private companies, plus AI-powered tools to streamline your workflow. It's no wonder 85% of companies in the S&P 100 are clients. Learn more at spglobal.com/proinsights. That's spglobal.com/proinsights. Think about how your company operates. Your sales and marketing teams have a platform like Salesforce to keep everything organized and drive growth. Your HR department uses something like Workday to manage payroll, benefits, and onboarding. Finance, they're probably using a top-tier platform like NetSuite to keep the numbers in check and streamline operations. But what about your M&A team? The team handling the company's largest, highest-stake investments? They're likely still managing everything in a folder full of spreadsheets. Now that doesn't make sense, does it? When it comes to M&A, especially buyer-led M&A, the stakes are too high to rely on outdated tools. Just like your other departments have specialized solutions to drive efficiency and success, your M&A team needs a platform designed specifically for them. That's where DealRoom comes in. DealRoom is built for companies that are serious about scaling their M&A efforts. It centralizes your entire M&A process, from managing the pipeline, through diligence, and into integration. It's about creating one seamless flow that eliminates inefficiencies, reduces the risk of errors, and enables your team to handle multiple deals concurrently. And just like your other departments are preparing to leverage AI for smarter decisions and better results, DealRoom equips your M&A team with the tools they need to do the same. Whether you're handling hundreds of deals a year or billions in value, DealRoom ensures your buyer-led M&A strategy is executed efficiently, allowing your company to scale successfully. It's time to give your M&A team the same level of support and sophistication that the rest of your company enjoys. Visit dealroom.net to learn more about how we can help you drive efficiency, reduce risk, and leverage AI in your M&A process, so you can scale your M&A efforts like never before. Again, that's dealroom.net.
Hello, M&A scientists. Welcome to the M&A Science Podcast, where we learn from the best in M&A to uncover proven techniques for enterprise value creation. If you're interested in learning more about how to optimize your M&A practice or want to get involved with our community of forward-thinking M&A practitioners, visit mascience.com and subscribe to our free weekly newsletter. If you want to keep up with us on the go, head over to LinkedIn and follow M&A Science. I'm your host, Kison Patel, founder and CEO at DealRoom, chief scientist at M&A Science. Joining me today is Art Pappas, founder and CEO at Bullhorn. Bullhorn is a market leader in staffing and recruitment software. Today, we're going to talk about introducing strategic M&A to accelerate growth. Art, how you doing?
Good. Hey, thanks for having me.
We're here live. No, thank you for having me. We're here live in person.
Well, that's true. Yeah, you're in my office.
Bullhorn headquarters right here, downtown Boston. Can we kick things off a little bit about your background?
I was a software engineer, and I was working for a startup, and I was right out of school. I was probably 24 years old, working for this startup. It was not going well. The startup was going out of business, and I had just met the two guys that I was going to co-found Bullhorn with. I didn't know I was going to co-found the company with them, but I met these two guys through a friend, got introduced. I wanted to start a company. They wanted to start a company. We had different ideas. We had had a good conversation. And then my startup that I was working at went out of business. And they pulled me aside and said, look, we can't can't afford to keep operating. We're going to give you a severance. And I said, what's a severance? Yeah, I'm 24 years old. I didn't know what a severance was. And they said, we're going to pay you for a little bit. Even though you don't have to work, it's just, separation pay. I couldn't believe that anybody would do that. And to me, that felt like that this is the opportunity. So I called my co-founder, Barry Hinckley, and I said, Barry, I think this is a sign. We got to go. Let's start a business. And he quit his job, I think a couple days later. And eventually the third co-founder, Roger Colvin, quit his job at Deloitte. And so we started Bullhorn. And so I was the chief technology officer when we started the company.
What year was this?
This was 99.
Okay.
Yeah. So I was originally the product programmer guy, the technology guy, and eventually became CEO later. But
you're doing this right in the middle of the .com bubble.
.com bubble, yeah. And I think that was why we all had urgency to start some business. It felt like the internet was this hot thing. I had been building products for the internet, and they were products that other people had come up with, but I didn't feel like they were capturing the real opportunity of the internet. And obviously that company went out of business. And so that was true. But I felt like there was all this like activity and all this opportunity, and somebody could create something really meaningful and powerful. And so I think, that turned out to be true, but the thing that we came up with first didn't end up being Bullhorn as it exists today. We didn't come up with staffing software right away. That took about 18 months and ended up being a pivot.
So you started as a tech lead, but your role evolved over the years because now you're CEO. How'd that happen? When M&A come in play?
Oh, M&A came into play much later once we were private equity backed. But initially, we started with a different business model. We ended up discovering the staffing industry, kind of fell into it backwards. An investor introduced me to the owner of a staffing firm who it was sort of like, hey, what you're trying to do is build a freelance marketplace. You should go meet my friend who runs a staffing business. They essentially do what you're trying to do, but they're the offline version. And that opportunity to meet this business owner really kind of changed the whole trajectory of the business because, they described to me this problem of having one database in one office and being very successful. And then once they went to multi-office and they had many, many offices trying to collaborate, each with their own database, it was a huge challenge. And they kept spending money on R&D to try to synchronize databases. And I said, well, why don't we put your database on the internet? And this business owner got it immediately and said, okay, let's go, and I'll pay you. And I think it was like, I'll pay you like $25,000, something like that, a month, which just like floored me. And that was like the business. We just went, and so it took a while to build the software. But once we did, it was very clear that there was an opportunity in the staffing industry wasn't called software as a service back then, but it was very clear that was going to be a great, great business, selling internet-based software to staffing firms to help them run their business from start to finish. And that's what I've been doing the last 25 years. I was originally CTO. There was a point where it made sense for me to take over as CEO. And that was right as we were really starting to commercialize the software. And that was really, it was a really tough time. We weren't able to raise capital. And that was sort of like the founders putting their heads together and saying, okay, like where should we all focus? And I was able to focus on the business, and my other co-founder was able to go focus on trying to sign up as many accounts as he could because he had a sales background, and our other founder was really operating as like a chief operating / CFO. And so the three of us kind of divided up the labor that way. And it just made the most sense for me to take the CEO role. And I've really enjoyed it over the last.
So that was pretty early that you.
Yeah, it was like 2003.
Okay, so pretty early you moved right.
So I
into
really
the CEO
enjoy.
role.
I love the CEO role. It's a great role. It's I've grown into it. I wasn't good at it on day one for sure.
I like it too, but I don't like competing with the CEOs that have engineering backgrounds. They're not. I don't know if you know
They're
why.
dangerous.
They are. They are. I don't like that. It's
Well,
just,
yeah, you stay really close to the product. As a founder, technical CEO, as long as you understand go-to-market and as long as you understand finance and you can manage those things and you understand product, you're really good with customers. You can understand the customer's problems. You can understand competitive dynamics. Is this competitor a real threat, or is this competitor sort of like a feature that we could replicate? And I think that's very important. And also too, you understand good software. And so when your team is putting out great software, you know what it looks like. And when you're missing the mark, you know what that looks like too. And you're able to get in there and say, okay, like this is a great product.
I was thinking something a little similar, the ability to really zoom in, problem solve, zoom right back out, and have that full picture view. That thing is, I think you got to really go through a type of engineering program to learn to think that way versus learning the soft skills anybody can learn over time.
I think that's true. I think a lot of engineers like to stay zoomed in, and that's a challenge. And I enjoy zooming in for a period of time, especially when I'm problem solving, and I'll get very intense about trying to solve a problem. But I also say, okay, once I feel like I've solved the problem, then I do like stepping back and looking at the full picture as opposed to just focusing on one component of a solution. Or
I'm not going to your space. I'm not going to compete with you. So you bootstrapped for a while. How long did you bootstrap for?
Yeah, well, sort of a funny story. We did a Series A round in 2001. We did an early Series A, and we had no business raising money. We had no revenue, but we did a Series A, and then the bottom of the dot-com market fell out. And I'd say like the dot-com boom led us to raising money, too much money too early, and spending that money too quickly. And because that's kind of like what investors encourage you to do. Oh, you got to build the brand and collect eyeballs. That was like the number one thing was how many clicks per day are you getting? And we quickly moved away from that. But essentially, there was the funding environment for software as a service was horrible in 2002 and 2003. And I would go to venture investors and say, hey, I've got a software as a service business. It's approaching $1 million in revenue. Would you be interested in funding it? And the answer was a resounding no. I mean, people told me, I remember one meeting I had with a venture capital firm that ended up later investing in Bullhorn many years later. The meeting ended abruptly when the partner said, look, enterprise businesses are never going to buy software as a service. It's always going to be client server. You're just crazy if you think they're going to use the internet. So fortunately for me, she was wrong. And later they got it and they came around and invested, but people were very skeptical. And I think in a way though, that forced a discipline of like, we can't just raise venture and have free money. Like we're going to have to sell our way through this period of time. It also wasn't a great economy. And so it just forced a lot of discipline around expense management and being really thrifty and learning how to go get customers to help you fund the growth of the business. And we were fortunate. We had some really good luck with that. We got some customers to lean in and take a chance on us, and some big customers to do that. And that allowed us to grow organically. I think, we got to 20 million. We were still growing 50% year over year. So we did the triple, double, which people talk about. You want to triple your business 2 years in a row, and then you double it the next 3 years. That's that we were able to do that. But unlike most venture-backed businesses that do that, burning money along the way, we were doing that cash flow break even. And so it just spoke to the demand for the product. It spoke for that we had a really great product market fit. And we had a huge lead in the market too. And I think we were the best SaaS solution that was on the market. And then when we opened up our ecosystem, like created an open API, that really made the business explode. And so you asked about M&A. We got into M&A when Vista Equity came along in 2012 and said, I want to acquire the business. I didn't know anything about private equity. I certainly didn't know anything about mergers and acquisitions.
We didn't raise anything between that 2002.
There was a round in 2008 where we raised some capital. Most of that was secondary capital used to buy back shares from the original Series A investors and some of the angels. And so that was really mostly a secondary raise. So we put some money on the balance sheet. We didn't really touch it. So we basically continued to be profitable throughout that period, which was really interesting. So it was largely a secondary capital raise. We thought we might actually burn money for a period of time, but we were able to grow faster than we expected. And so
there's another recession going on right around that time.
Yeah, 08, 09 was a little bit of that was a tough time for everybody. But at 2010, 11, we had great growth coming out of that. And it was just, we just didn't need to burn money after that. And then Vista came along and said, hey, you got a great business, but you could be doing a lot more. And let's talk about what you could do with M&A. There are some businesses that we think could be really great complements for this business. And, naively I said, well, I don't want to raise $20 million in equity to go buy out one of these businesses. That's going to be so dilutive to my shareholders. And they said, no, that's not how it works. There's this whole debt funding capacity that you can tap, and you can tap the debt markets for capital. And it's all you have to do is pay the $20 million back at exit. And that didn't take me long to figure out, like, leverage is an amazing, amazing thing. If you can create growth, either of EBITDA, but ideally of revenue, and that revenue growth generates EBITDA. So, so it's a simple math equation. So, like, let's say that you think your business can generate 20 million a year of bookings, but you do this acquisition and you can double that to 40. Well, paying $20 million to buy a business that could generate $20 million of bookings for you is a no-brainer. In 5 years, you'll have a $100 million business. Paying $20 million for that business could be throwing off a ton of profit. So, the math really, really makes a lot of sense, especially if you're using debt. And so, so Vista taught us, here's how you not only acquire a business, negotiate the deal, get the LOI signed and close and fund it. They also taught us, here's how you integrate it to make it successful so you can hit those sales targets. And I think that was a really great experience working with Vista as our first private equity sponsor, because they actually had best practices around acquisition integration.
It's interesting. Lately, I've been really focusing on a thought leadership point of view called buyer-led M&A. And for me, just doing all these interviews, I always see when a company builds their M&A capabilities, the first deals they may do is really led through a bank process. It's really driven by the sell side. But as they continue doing more and more deals, it evolves and it just becomes more buyer-led, more emphasis on integrating the company, a lot of those considerations coming in early, even just being proactive about finding the deals that really match your strategy versus waiting for bankers to bring you stuff. And it sounds like with this example that working with Vista, they help you accelerate that pretty quickly of like being more buyer-led.
No, absolutely. We were buyer-led. We didn't build a team right away. Vista had deal folks that were involved in helping us prospect for deals. They would help us negotiate the deals. Now we do that in-house. But their whole methodology was you need to canvas the entire market, have a database of every single target that could be actionable, and you need to decide which deals you want to pursue and which ones you want to pursue aggressively. Don't wait for the book. You go make the deals happen. And I think that's anybody who has an M&A strategy and is just waiting for the bankers to tell them what to buy. I mean, that's like, to me, that it makes no sense. You shouldn't even do M&A because you're doing the wrong deals. Like if you're not looking at what are the alternatives? Oh, the banker gives you a book and they said, here, look, this beautiful business. They don't tell you it's the number 3 product in the market. Don't you want to own number 1 or number 2 at least? And so, or at least know that you can't buy number 1 because it's too expensive, or they don't have realistic valuation expectations, or there's a problem with the business, or whatever it is, or they just don't want to sell. But okay, you want to go into that transaction knowing here's what I'm getting. I'm getting the best asset that I can get at a price that makes a lot of sense. And I know from diligencing the asset in the market, that's it. Another thing is you can't diligence an asset in the diligence period that a banker will typically give you. They'll give you 6 weeks. Okay, you've signed an LOI. Now we're going to do final bids or due 6 weeks, usually, maybe 4 weeks, maybe even 3 weeks, depending on how competitive the process is. So if you aren't canvassing the market and finding, here's the targets I want to go after, and then going and talking to their customers, how good is this product? You get a book from a banker, you're flat-footed. You've got to, it takes a long time to have lots and lots of conversations with customers. And so we do a lot of that. We front load all of that work. So when we approach a business and say, we want to buy you, we know what the customers say already.
Okay, so if you look like a bank process, running an auction, trying to get the highest price, pretty reactive, right? You're responding to their process.
Totally.
Versus proprietary deals. You're very proactive. You're building those relationships. But the key element is the diligence. You've got such a bigger time frame to really do the diligence, talk to those customers, know what you're getting into, build a rapport with the executives over there, and then probably be a little bit more amicable as you actually move through the process of the little things that pop up versus somebody that really wants to close that deal as fast as possible so they can get their cut.
Totally. And, I would say that most M&A diligence focuses on financial diligence. Let's look at the quality of earnings. Let's look at the spreadsheet that shows the revenue retention. But all of that is like looking in the rear view mirror as you drive. And so those metrics reflect like how healthy was the business a couple years ago. When you talk to the customers, you get how healthy is it now? And that's it's the hardest diligence to do, but it's also the most important. And so sometimes we'll look at a business and the financials don't look that great. And the CEO will say, yeah, we had a problem with customer experience. But we know that they did. And we know that the customers were saying that it wasn't that great, but now it's gotten better. So we can look past, okay, you did have an issue with churn, but now we know the customers are telling us that you've solved those problems. So we're okay to move forward, where another buyer might look at those same metrics and say, I'm going to pass on this business. Could be a great business. Sometimes businesses struggle with product market fit. It takes them a couple years to get there. Sometimes they have leadership issues. So that customer diligence, I would say, is that's like looking in through the windshield on the business you want to drive rather than the rearview mirror.
How do you approach that? I worked on a deal earlier in the year, and I got to the customer saturation, which I thought, hey, there's some interesting there's to look into. But early in the process, they weren't comfortable listing, because a competitor, they weren't comfortable listing the customers. How do you, does this sort of focus more post-LOI?
No, that's a really good question. I think if you're a horizontal solution looking to acquire a business that focuses on other horizontal solutions, it's hard unless you have a huge customer base. Bullhorn enjoys the fact that we are in a vertical market. And so we really focus on one type of buyer. And so when we go and sit with those buyers, we ask them, what solutions do you use? We talk, of course, about our solution and how that's going, but a critical part of that conversation is, what else do you use? Who do you buy software from? Oh, you use this company. Interesting. We know that company. What do you think? And for instance, we have a CIO forum. We bring CIOs in once a year and have an event. And we'll go around the room and say, who are your best vendors? Who do you really like right now that's providing software that's unique and driving value in your business? And, our corporate development team is part of that meeting to sit there and say, okay, that's really good. I need to take note.
So there's access you can have from your existing customers that give you a sense because you're talking to the other products customers that way.
Yeah.
Do you ever ask for it when you're in those early conversations with the executive? Like, hey, do you got a couple customers I can talk to? You don't need to.
I don't even ask. I mean, frankly, because like you said, like most businesses don't want to bother their customers with, hey, will you talk to this person that might buy me? That creates a lot of anxiety. Whereas if we are just having conversations with customers all the time about solutions they use and how they value them, they don't see it as, oh, there's a deal going to happen. They just see it as us just trying to understand. It's actually beneficial for the customer too, right? Because, okay, Bullhorn understands not just their piece of my tech stack. They understand the whole tech stack and how it works together and what's important to me. Sometimes, we have many products. Sometimes one of our products could be installed at a customer and it might not be the most important part of their world. And we find out, well, they've got this other thing that's driving huge value for them in their business. But if we're not asking those questions, we won't even know that. And, it allows you to give better service to the customer and allows you to get in front of.
That's a big thing I've been learning because I might have mentioned earlier that I've transitioned from all the internal operations of purely working on the business as opposed to in the business. So it's a different way you face with the customer. It's more about understanding that broader ecosystem versus just are they happy with the current product and what can we do to improve it?
Yeah, I mean, for us, everything starts with the customer. It's what's important to the customer, what problems are they trying to solve, and where are they focused and where are they going with their business, and so we're constantly thinking about how do we meet that opportunity, and it's evolving. So if the deal we just did, text kernel, years ago, customers said, there are a lot of players in this market that do search and match. Search and match is really important in the recruitment space, but none of them really have like a great product. You guys should do that. And we looked at it and we looked at the players in the market and we even looked at this company, Text Kernel, which we just bought. And we felt like they weren't quite there with the product to the point where the customers were raving about it. And okay, so customers are telling us they want us to solve a problem. We wanted to solve it, but we were concerned that maybe what customers wanted wasn't possible technologically. And fast forward 4 or 5 years, customers are telling us this product has come way, way, way far along. They're fantastic. They're doing a great job. Okay, wow, if we owned that, that could be really powerful. We could really, really do a lot of amazing things now that they've cracked the code. But we had to be there at the right moment, constantly pulse checking on how's that going. So,
well, you got like 1,400 employees now?
With Text Kernel now 16.
1,600? You still talk to customers and go through this exercise?
Yeah. Oh, yeah. I mean, I don't personally talk to all 10,000 customers.
No, but just, to get the pulse. I don't know if you just...
But that'd be cool.
Source it to a strategy team or something. Just wondering.
Well, we all do. All the executives in the business try to talk to customers. I mean, that's our job. We got to stay. We got to stay close, and so.
Oh, can we go back to the Vista? So, the Vista part you mentioned, just hey, they approached you, and you're kind of like, you're trying to understand the model, and the depth part got you interested. I want to get a sense, because I'm saying, I'm doing this interview to get a lot of free advice. Just people listening probably picked that up by now. Because our business is about 10 million run rate. I've bootstrapped the business. I don't have any outside capital.
Yeah, good for you.
So I want to play the counter argument on this of like, we get approached every month. I get 5 to 7 inbound inquiries, different investors. I'm like, a little hard hit. I want to get to 25 million a year. Then it'll do something, because I gave equity to employees and they're incentivized. But like when you have the P firm, I'm right away, I'm thinking dilution. And it's for me, the exercise of like wealth preservation that, hey, if I do this, I'm losing up control, equity, and you did that, but that you came up with that piece of like, hey, we got this tool of debt that we're going to use and really do some big bold moves that's going to unlock a lot of value. Can you click me through just a little bit more of like what that thought process was to get you to like change your mind?
Yeah, I mean, I think certainly to do M&A well, it's really hard if you're small. I think we were approaching 45 million in revenue when we did the deal with Vista. So that's about, that size, you can start to think about doing M&A. When you're 10 million and you're growing really fast, all you can do is hang on to your hat.
I'm looking at really crappy deals is what you do when you're at 10 million. I'm a deal guy, and I gave up all the operational stuff because I don't like doing that. I want to figure out how to get the business to a point to do M&A.
But I think the calculus around, anytime you're taking on a private equity investor and engaging a sponsor, I think you have to say, okay, yeah, I'm going to cede some control. But if I do a great job, I control the destiny of the company, because as the CEO, if I have a great vision, the investors are just going to want to go along with me on the journey. And I think that's the thing that people forget. They think like, oh, the financial sponsor gives me the vision. Sometimes that can be true, but it's not ideal, because then, you're CEO, you're trying to paint by numbers and follow somebody else's lead. It's much better when the CEO and the management team have a vision and they say, okay, this is where we think we can go. This is how we're going to get there. The financial sponsor helps you think through things you might have missed in your plan, helps you think through how you're going to finance acquisitions and, how to make the numbers work. But ultimately, you're in the driver's seat. And the other thing is like, well, okay, if you do a deal with a private equity sponsor and there's liquidity for you and your team, now you can take risks that you might not have taken. And I think that's an important thing. That was an important thing for Bullhorn. That if you look at my management team, everybody's been in this business a while. Like I think the least amount of tenure in the company is 5 years for my my direct reports, and the most is just over 20. So, and I have a number of executives who've been at it 20 years or more, and so it's a very like long tenured team. And what that means is they haven't been in the C-suite or the SVP or EVP level for 25 years or 20 years. They have been, they started their journey with Bullhorn like at the entry level and worked their way up to vice president or director, vice president, eventually senior vice president, and some of them now in the C-suite. And I think when you have that, you have almost like a founder mentality. And so I really say like, yeah, I'm the last remaining co-founder in the business, but I have new co-founders, newly minted, in the last decade, in the last 20 years, because these people grew up and they feel a sense of ownership. What that leads to is like, okay, then at a certain point, they might, because they grew up, they started their career here, their Bullhorn experience is like their whole life. It's like their livelihood. And so you do have to de-risk that a little bit to say, okay, let's get everybody focused on taking some risks and taking some bets, as opposed to being, like you said, thinking about like, I just want to preserve what we have. And I think that's why sponsor deals can be really helpful.
So having the great vision and having that relationship with investors that they're really aligned with that vision, ultimately creating a positive relationship. So it's not, because the bad is if it's some friction, or you hear the stories of having friction and then you give up control and your life isn't as nice as it was.
That happens. You see it all the time, and it's really hard to predict. Who's going to have trouble and who's not.
Well, we'll have to come back to picking up the good investors. I'm curious about that. I'm going to make a note on that.
I don't actually think it's good investors, bad investors. There are such thing as bad investors who behave badly, but most investors I found, the last thing they want to do is a CEO search.
Yeah.
That is not what they want to do. They don't want to, it's time consuming, it's stressful, it can break the business, they can lose lots of good talent along the way. It's really bad for them. They really want the original CEO who was at the helm to stay at the helm. What I see a lot, though, is that people struggle with the transition from either venture-backed or bootstrapped to private equity-backed because it's so different. There's a high level of scrutiny on the finances, and if you're not a detail person, you don't care about the finances that much, and suddenly somebody who owns a big share of your business does, and they detect you do not care about the thing they care most about, that creates an impedance mismatch. It's like trying to put two magnets together. It's never going to work.
Yeah.
Or if you don't care about operational metrics that they care about, like, well, we got to improve our cost to customer acquisition or our customer retention. Oh, no. We just sell more software. Don't worry about it. Two magnets coming together.
Yeah.
Or you're used to just burning money every year and they want you to be profitable. And you don't understand why they don't get it. It's like, you got to understand that stuff. You really got to understand what good looks like for them. How do they make money? And align with, okay, if I do a deal with them, I need to make them money. I need to help them such that we're going to make them 2 to 3 times their money in the next 3 to 5 years. And if you don't know how to do that, then you will probably end up being one of those CEOs that doesn't work out, because they're going to figure out how to get to their return.
So that's probably the best thing, is to get aligned on what those key metrics are going to be, what are, what their ultimate goal is, profitability versus just pure growth, the returns that they're looking to make, and then sort of have that level of confidence that you can deliver on that. The M&A part of that story, do you already know that, hey, with this capital, you can make some bigger moves? Do you already have some thoughts? Is there like an initial pipeline that, hey, we could go after this company, or is a P firm coming to you and saying, hey, we're interested in this because we mapped the marketplace out and see there's a lot of opportunities for you to consolidate?
Vista was the latter. We created our own internal team at the end of our hold with Vista. And so...
so beginning is private equity led, then later is more internal.
Yeah, so we brought it internal 2016. And so now today, when we go sit with a financial sponsor and talk about, what could it look like, we have hundreds of targets in our M&A database. We've got them tiered. We know what their revenue is. We know how they're growing. We know which ones are A targets versus B targets versus C targets. We track them. We try to contact them once every quarter, or at least once every 6 months, and get an update on how they're doing. We talk to their customers. We're gathering data all the time. And so we know which ones are actionable. Here are our A targets that we want to go after in the next 12 months together. And so that's a very productive conversation.
How many deals have you done total?
It's in the teens.
Okay, in the teens.
Yeah, high teens.
How many other P firms came after Vista?
So first it was Vista, then Insight and Genstar came in together at the same time and bought down Vista. And then Stone Point came in 2020 and bought a share from both Insight and Genstar.
Cool. Those are your current shareholders.
Yeah. Yeah.
Yeah. So it hasn't
And
been,
they've all been fantastic. Just every single one has been a great partner.
I think I've heard good things about Insight. I've not worked with them directly, but I've heard really good things.
I can
And
say
Vista too.
great things about Vista, GenStar, Insight, and StonePoint. They are all phenomenal. And StonePoint is now sort of the primary shareholder we work with the most. During the years that we worked with Insight and GenStar, they were super helpful, but both very different firms in the help that they provide. And then StonePoint. StonePoint's unique in that they have a concentration in the human capital space, and they know a lot about our customers. They own a staffing business, so they kind of understand what is it like to be on the other side and be the customer. But they also own a vendor management business that our customers interact with, and the buyers of our customers interact with, and so they know a lot about the human capital space, which is fantastic.
Yeah, give me the good and bad about the private equity firms. 'Cause it feels like it's really interesting that you got a lot of acceleration and just the maturity of building your M&A muscle capability early on with Vista. And the SharePoint example, it's you're getting a lot of interesting market intel from them. You know, like I want to get a sense of like where it sounds like there are some like the right investors. You got alignment on what the goals are in the business, that they do help you out quite a bit. I'd be curious to know, like, what are other areas? And
yeah, I mean, I think the knock on private equity has always been, it's slash and burn and cut costs and like, yeah, of course there's a focus on profitability, but I think there's a people's perception of it is like, oh, profitability means you're like firing people all the time. Like that is not what we do. Like it's like we're in fact we like to hire people and grow the business. The business when Vista acquired us was probably 150 people. It's well over 1,600 today. So I think a lot of the focus is on like, okay, well, what about the M&A you do? And I think the thing that we've learned that's been really great is like, how do you integrate these businesses into yours? And the key, a lot of people who do M&A, and I don't know how other software companies do it across the board, but I do know anecdotally that what I hear from other CEOs is like, oh yeah, we acquired this business and we're going to leave them alone for at least the first 2 years. And I don't like that. And my team doesn't like that. We feel like, and we learned this with Vista, when you go into a business and you acquire a business, the worst thing you can do is tell people, we're going to leave you alone. Sure, you can do that, but usually what happens is once you own the business, you see things that you want to change. But if you've said, we're going to leave you alone, and then you go to try to change, well, I just want to change this one thing. People say, well, you said you were going to leave us alone. Now you want to change our comp plans. Now you want to change our benefits. Now you want to change. You can't do that because it's like, why are you buying the business if you just want to leave it alone? You could invest in the business, but now you own it. You should be upfront. We are going to change stuff. You have to be transparent. I think that's key. And you can't just go in guns blazing and start like making changes. Like, oh, we know best. That in the early days with Vista, we learned that because Vista's playbook back in 2012 said, you go in and you catalog every single change you want to make in the business and you make it right away. Well, we learned and they learned that that's not always the best thing to do because you make mistakes. When you go in guns blazing like that, you make mistakes. So we, together with Vista, quickly calibrated like, well, maybe we need a period of time to learn about the business. But the first thing you do is you go and you say, look, we bought the business. Things are going to change. Dear employee, congratulations. You've been acquired by Bullhorn because your business is amazing. You built something fantastic. You worked for a great company. Now you're joining a great company and you should learn about our culture and what it's like to work here. And people will say, well, what about our culture? Well, like, congratulations. You built a great business, a great culture. It's been acquired now. And so you need to think about it as if you've just started a new job. And the new job is at this company, Bullhorn. And when we don't say that in a harsh way, we say it in a way that's like, we want to be honest because you're a smaller company, we're a bigger company. Our culture is going to be the culture that ends up staying long term. Of course, your people will stay. Like, you will become part of Bullhorn's fabric, and we want you to embrace our culture. Like, we would never hire somebody and say, hey, we behave a certain way, but you can behave however you want because you're cool, we hired you, we're going to leave you alone. No, like, we have behavioral norms. Our employees need to sort of adhere to them, and we call those our core values. And they're just behaviors like, respond quickly to customers, or give people the benefit of the doubt, or always do what you say you're going to do. And so we expect the people we acquire to adopt these cultural norms. We tell people we're going to make change. We evaluate the business for 3 or 4 months, and then we say, here's our plan. This is what we're going to do. This is what we're going to change. This is what we're going to leave the same. And people love that. They don't love it at first because people hate change. But then once they embrace it, and some people leave, some people are like, I wanted to be part of a small company. Okay, good to know. Thank you for raising your hand. We can work with you. Let's do a smooth transition. Maybe we'll even help you find something else if a big company isn't where you want to work. But great, let's know that early so we can wrap our arms around the people who do want to stay. And because I think what happens is a lot of these businesses, like, you leave them alone, but they're working for a bigger company. You start to chip away at their employee experience. They're not at a startup anymore. The best people leave because you haven't gone in and gotten to know them because you're leaving them alone. It's like the worst thing you can do, because the best people leave, and the people who don't have great job prospects actually stay. You may not want those people. You have no idea whether they're good or bad. It's like, you need to get in there, evaluate the people, like, make them part of your culture, and see who's going to be a great performer in your business, and then say, we really value you. You're fantastic. Like, you could be, hey, we have a VP spot open over here. Are you interested in that? That's it. That completely changes the game. Makes them feel like they're part of something that's special, as opposed to being an appendage on a bigger business, and they don't really care about us. We don't matter. All they do is screw with us at the end of the year on our bonus and commission plan. Like, that's the worst. To me, it's the worst.
I like it's very proactive, especially around the change that you're communicating. This is like a new job. And I think that maybe it's going to give that same shock effect, but it's not keeping them in the dark. You're still keeping them in the light, and keeping that transparency communication that, yeah, there's going to be changes, but at least they'll come around and say, okay, these people aren't that bad.
Yeah, I think it's just being honest about what it is. Because when you say we're going to leave you alone, that is just not true. It's dishonest. And either people know it and they know it's not true, and now you've established that you're lying to them, or they don't know it and then they're horrified when you don't leave them alone. And they say, wait a minute, you told us you weren't going to, well, it's just this one thing. We're just making this one change. And then the next 2 months you do it again. And they're like, you have no credibility. I hate you. I'm leaving. And so it's like, just be honest. Like, stuff's going to change. We don't know exactly what yet. We'll let you know in 3 to 4 months. We'll have a plan. We'll communicate it with you. We'll be open. And people can appreciate that. They may say, I don't like it, but at least you can deal with that. And you find out, like, who doesn't want to work for a company of 1,600 people. That's good to know. And maybe you don't lose as many people as you would have lost. And you can get in front of these problems a lot easier when you're up front.
I like that, being up front, and just the cultural piece of, like, think of it as a new job, joining a company. Are there anything else that you do to make integration go smoothly and quickly over the...
A lot of planning. Yeah, we track all the things we need to do. And we have a database of things that we know we need to do. Like, stupid stuff that people forget. How are we going to cut over their email? How are we going to cut over their Slack? When is that going to be done? Well, let's have a plan before we even close the acquisition of, like, when that will be done. So on day one, we can communicate, hey, everybody, you're going to get you're going to get brought into our email platform or our Slack on this date, and here's how that's going to go. And then like all that stuff, there's like a million things. What about the website? Are we going to, drape our logo over their logo in the web? No, we're going to put a little banner at the top. You plan all these things and everything's planned out. That makes people feel comfortable. Oh, okay. There's a plan here. It's not just going to be crazy haphazard stuff happening as people think of it. And that also prevents a lot of mistakes. Because if you just leave it to chance, like, oh, shoot, we forgot to update the website. There's nothing on the web. Then customer calls and says, I read you were acquired, but there's nothing on your website. All of a sudden now you have frontline tech support people feeling like, does this company even know what they're doing? Right. Horrible. So you got to get all that stuff right because customers see it. Everybody's watching. And so it's like, you need to say, okay, here's how we do this. Here's the playbook of every time we run an acquisition.
I was going to say, you're probably building playbooks over time to really make sure you don't miss those details. When you get an LOI signed.
One more thing on that.
Yeah.
And all you have to do to get that stuff right is put yourself in the shoes of an employee. Okay, how am I going to feel when this happens or that happens? And I'm going to have, what questions might I have? Oh, are we changing email systems? Oh yeah, they're going to ask that. Oh yeah, we should have a plan. Same thing, then do the same thing, customers and partners. And if you do that perspective take, customers are going to have a lot of questions. Why don't we have a frequently asked questions that we can give to customers or at least give to our sales and customer facing staff so that when customers ask, they can just read off a sheet. Oh yeah, we have no plans at all to end of life that product. In fact, we're going to be investing more. And now all of a sudden the customer goes, oh, that's cool. That's really great. As opposed to,
I like that a lot.
I have no idea. We just got acquired. I have no idea. That's like the worst thing you can say to a customer. They're like, great, thank you. I will create an RFP and I will go to the competition. So it's important an exercise to imagine being a customer, what questions you might have, imagine being an employee. So we create these FAQs and that helps inform some of our planning.
And you could have that with customers, but probably other areas as well, like with obviously leadership. They're sort of working with their own employees and the vendors.
Our employees are going to have questions too. So we have to create internal FAQs. Oh, what does this mean? What does this acquisition mean? What's happening? So a lot of FAQs when we do an acquisition.
I like that.
But if you don't do that, it's chaos. So you quickly learn, hey, we got to answer these questions once in a document rather than having every single leader in the business trying to come up with answers on the fly, giving the wrong answers. Now we got to clean up the wrong answer. Somebody told the customer that we're going to end the life of product. Oh my God, why did they do that? Let me get on the phone with the customer and calm them down. So what could have taken 5 seconds takes hours. So it's just about it's a lot of planning to make something really efficient.
When you get the LOI signed, how much integration do you have planned? Is there?
We know the basics, right?
Pieces.
But at LOI, we don't do a lot. It's usually from LOI to closing, we're building our sort of what is our plan for the first 90 days. There's stuff we know we're going to do day one, like update websites, press releases, FAQs. But then the 90 days after is when you go in and you say, okay, what do these people do all day? And what would those roles look like if we integrated them into our business? Like if they were using our support methodology, would their jobs be different? What tools do they use for development? Okay, do we want to try to migrate them to our tool set? That might be hard. We'll leave them on that tool set, but we'll integrate them in. And who are going to have lead that team who has experience with the tools that they use? So all that sort of like stuff that you got to answer. Are the products already integrated because they're a partner? Great. If they're not, How are we going to integrate the products? Like, who's going to own that?
I was wondering if you try to identify big risks early, like even before signing LOI, i.e. the tech stacks are totally different. They're Python based or .NET or something like that.
Yeah. In diligence, we spent a lot of time on tech stack. We spent a lot of time on code quality and a ton of time on cyber. And
this is post-LOI.
Post-LOI. Ton of time on cyber. That is because it's very important to understand how has this company protected its customer data and its employee data in the past, and how are we going to protect it once we own it? Because the minute we close the deal, we own that. And so you really got to understand what are their cyber defenses? And most smaller companies are unsophisticated in that. And
But is that emerge as like hey, this is going to be a red flag, we can't do the deal, or this is us having to really get serious about a roadmap to get this company up to standard?
Yeah, it's both. I think sometimes
you had security so bad that you're like, we can't do this deal. Really?
Yeah.
Wow.
Unfortunately.
That concludes our intro. I feel like we got through that. Are you ready for the real interview? For me, it'd be really interesting to really get a understanding or learning how you look at synergies. I think that's something even I'm trying to figure out looking at deals. Right now I'm looking at really shitty deals where I got to kill the product and move the customers over. Did you ever do that before?
Kill the product and move customers over.
Yeah. You have to.
I would not do that. I don't recommend that.
Have you done it before?
In fact, when we first started working with Vista, we acquired a product that had a ton of overlap with our core product.
Yeah.
And so I said, we don't want to sell two competitive products. Should we kill it? And they looked at me like, you never kill a product. If you say we no longer support this product, and it's funny because we had a competitor that killed the product line that competed with Bullhorn. It was a field day for us because we got we must have, and they called us and they said, do you want to buy this business from us? And we're like, nah, I don't think we want to buy it. And that was when we were venture backed. And our thesis was, if they kill it and they shut it down, we're going to get 70% of the customers. And we did. And so I think if you acquire a business and your intent is to say, I will no longer offer that product anymore and you must move to this other product, you're just going to lose the customers because nobody likes to be forced to change software. It's an awful thing. People hate, especially if it's like mission critical software that's really important. So the best practice would be, okay, you acquire the business. They have a product line that you don't want to continue to invest in. You have to maintain it. You have to continue to fix bugs, make sure that if there's stuff you got to stay on top of from a regulatory standpoint, you got to stay on top of that stuff. But you can tell the customers, hey, we really want you to migrate to our flagship. We're never going to force you to get off this thing unless something, maybe 10 years from now, we might have to have that conversation, but we will support you. But our intent is for customers to migrate to this platform over here. And that works really well because customers get that. They're like, yeah, I get that, okay, your product's better than theirs. Okay, fine. And if your product's not, they'll say your product's not better. Here's what I would expect your product needs to do if I'm going to migrate. Okay, do those things immediately, right? Close the gaps. We've done that before. We'll go in and say, okay, we know our product has some gaps. If we close them, will you migrate? And eventually, customers will migrate. Now, they might go to competition over time, but they're not going to rush for the door.
So you've done that before, where it's acquiring a business. You have a very similar product. It sounds like a big piece of it is understanding where the feature gaps are. And if it's addressable, then you can potentially move those customers over to that product.
That's right. But if my competitors are listening and they make an acquisition, they should definitely end of life the product immediately.
Yeah, so if you just do that fast, that's what's going to happen. They're going to scramble. But if you planned it out.
Unless you can be with Bullhorn, because then it's the right thing to do.
It's the right thing.
Yeah. Force the customers to move.
If you're not, then put a nice runway in there and really give some time for that to happen.
I think, you nobody wants to be forced to do anything.
I know.
Nobody likes that.
That's only
Goes back to like eat your vegetables kind of stuff, you know?
That's the deals I'm coming across is we have our deal room product is like very buy-side life cycle, but it's complicated, right? Pipeline diligence integration. Those are tough ones to bring together. But the data room industry is like very commoditized. It's fundamentally upload, download documents.
Yeah.
So I see a lot of these businesses have been around 15, 20 years, very stagnant or it's slowly declining growth. And it's like, well, why don't we consolidate them? If we can move them over, we can get a lot of cost synergies, just eliminate all the tech. Forget tech debt, just eliminate all their tech and move the customers over. But
yeah, I would only do it if you intend to continue to support the customers that want to be on that system, at least for a period of time.
What is that, 12 months, year? Longer?
Years.
Years? Yeah, well, then you keep the product in maintenance mode, basically. And
yeah, and that's fine. Customers understand that. Okay, you're not advancing this product line, but I love it, and I want to continue to use it, and I'm paying you especially if it's SaaS, right? Like, it's a totally different story if it's client server, but if it's a recurring revenue stream, like why wouldn't you continue to keep that?
Keep it in maintenance and then just run it and try to move the customers over as you can.
You don't have to invest a lot in R&D to maintain a product once it's, unless the product is terrible, issues or something like that.
That's true. Can you give me like a little timeline of just some of the early? I'm just curious, like, what did the first deal you did look like? Like, what drove you to even do the first deal?
Yeah, great question. The first M&A deal we did with Vista was we bought two companies at once, Sendouts and MaxHire, and we announced them on the same day, and they both competed with each other. And that's where that competitive dynamic came in. And that was a blast because you're negotiating with two competitors and you're kind of hinting, well, I might do a deal with you, but I might also do a deal with somebody else, and you probably wouldn't like to read that press release. And then at one point, Vista said, why don't we just do them both? And so it went from telling them we might do a deal with one of you to like, hey, wouldn't it be great if all three of us did a deal together? And it was super complex negotiation, but it worked out really, really well. And both CEOs of the businesses loved the idea of the combination of the three. And so,
how did that negotiation go? Did you like get them all together in a room?
No. It was shuttle diplomacy. No, that would have been weird. Yeah. But so I would go and sit with one CEO and say, hey, here's what we can do and here's what it would look like. But I'm also talking to those other guys, and if we did something together, the three of us, it could be really great. And your employees would probably my employees would love that. That would be so cool. We've hated those guys. So if like, we don't have to compete anymore, we could put our forces together. It could be really great. And in fact, customers like that too. They like the notion that these three companies were coming together to create the best solution possible. And, some of the customers didn't like that. Okay, well, my solution didn't end up being the best solution, but it did it played out really well in that we were able to the three of us took sort of the best features of all the products and put them together into one, and it ended up being great. So
I guess I'm trying to understand the driver of that deal. How do we feel like there's the three buckets? It's either the tech, the customers, or the talent.
Well, this is an interesting one. All three companies, Bullhorn, Sendouts, and MaxHire, were facing, okay, we built our original flagship products in 2001, 2002, 2003. All three companies started around the same time, all competed. Bullhorn was bigger, but they had all built on the wrong tech. We had built on Cold Fusion. They had built on .NET, smart clients, so they were kind of like making people install software on the desktop to run the software. And so we were browser-based, which is probably why we ended up being the biggest. But we had to update our back end. And they had more features, and their smart client product was faster than ours in certain functions. So and they knew they were going to have to invest. We were going to have to invest. And it's like, these were businesses that did not want to invest millions of dollars in R&D to re-platform. And so we said, rather than do that and fight us, like, why don't we join forces, make one best of breed product on our platform for our joint customers? And I think that vision actually helped codify, like, this will be the best way forward.
That's interesting. It is a pretty powerful vision for the market, the customers. To do that, you had to re-platform, and you bring these companies over, but it sounds like you're rebuilding the feature set across the board. You're just combining it into one. You just rebuild all that.
We rebuilt the Bullhorn platform with the product lead for sendouts became part of the product team at Bullhorn. So he was deeply involved in what the new product user interface would look like. And then there were some features in the MaxHire product that people loved, and we would talk to customers about, how do we replicate those in the new platform?
So it's both. It's almost all three: the tech, customers, and talent.
Yeah, I mean, it wasn't free.
Well, no.
But what's interesting about that is the product lead for sendouts ended up leaving Bullhorn a few years later and started a company called Herefish, and he built a product that was like fantastic marketing automation product for the staffing industry. So we ended up acquiring that company once he hit around $1 million, $1.5 million in revenue, and that has been one of our most successful acquisitions we've ever done.
How do you look at timing on doing a deal? Because it's a really early stage company to buy at like $1 million revenue.
Really early stage.
But it's a big win, right? It's
yeah. Product market fit is really important. And I look at two things. One, what do the customers say about the product? And I get very nervous if I ask a customer, what do you think of it? They're like, yeah, it's good. And then I say, okay, what do you wish it did differently? And they can't tell me. With Herefish, my customers were telling me, product's really good. But you know what he's got to do? He's got to fix this, this, and this, and this, and this. And then it'll be ready for prime time. I hear that. That's product market fit. The product is providing value. The customers want more of it. And they're thumping the table saying, like, this thing needs to do this, this, and this. That's like, you have achieved something great, because that tells me this isn't just like, the revenue is going to be, sort of, it won't be that sticky. And so that gave us the confidence to buy a product buy a company at $1.5 million rather than waiting till they got to 10 million.
You mentioned earlier, like, horizontal versus vertical. And I'm thinking of that, but I'm also thinking close to your core, further away from your core that you go. So you've done a lot of these acquisitions. What does the thinking look like around that? That you buy a business, it's in recruiting, sort of management side, and then is it like, here's a really light product, but they have their own customers. We'll just leave it alone. Then you do something that's just further away. How do you sort of market map that or determine?
I mean, the best acquisitions we've done are ones that are products that our customers could use that we don't sell. Those are the ones that are always the most successful.
And that would be
same customer.
You look at that as vertical.
New product.
To the same.
That's cross-sell opportunity.
Right. Okay.
Yeah. But if you say, you could also say, we have done some deals that are, hey, this is a new customer segment, new geography.
Yep.
That's an easy one. We've done 3 deals in the Netherlands now to really sort of bolster our Netherlands presence, which has been great.
But it's still the same profile. Who's your biggest profile? As you said, like your biggest like customer profile?
Our
Like, give me one as an example.
Okay, so we service the of the top 10 staffing firms globally. We service, I think, almost all of them in some capacity.
Okay, so like staffing firms, basically, that's your sort of core customer base. Not okay, I get it. So
So you're saying, like, have we ever acquired somebody that's like, oh, we get, so a good example is we spent most of our time servicing staffing businesses. People would always ask about, what about exec search? Well, it's kind of a different business than a contingent staffing business or a perm placement business. So we acquired a company that did exec search software. And it's similar, but there are some critical differences in the software. And that's actually been a really good acquisition because we can cover the accounts with our existing sales team. They're calling on those accounts anyway because sometimes they're in the database, not tagged as exec search. And so we tend to call on those customers. And so now having a product to sell them is great. But that's an example of an adjacency. And so like going after a different type of customer that you don't service well.
I get that. What about like a go-to-market, like maybe the staffing firm example, where you have a direct sales model, you're selling to a certain profile into a staffing firm, but here's another company that does something totally different. Maybe it's more inbound or inside sales, and they're actually hitting another profile to sell their product, and it could be similar-ish, or maybe it's like hitting a different size of firm.
Yeah, so we will look for assets that target a different buyer inside of our customer. So CFO or the payroll department or compliance. And so we'll buy companies that service that side of it as well. But what we won't do is say this business is selling widgets to, like they're selling widgets to manufacturers. I don't know anything about manufacturing. I mean, maybe a little bit, but like automotive, like
they're serving a completely different industry.
Yeah. Like we're very focused on contingent labor, exec search, that human capital providers. That's who we focus on. And so TextKernel, they actually focus on providing software to a lot of the software players in human capital space. So now those are our customers. But again, it's like, okay, it's all related to human capital. And so we feel comfortable in that domain and recruiting. Like we get outside of that domain and it's like, oh, okay, we should go sell software to hospitals. I'm not good at that.
Got it. So it's keep that domain focus. And then it sounds like cross-sell is sort of the gold. Like if you can find where there's a clear cross-sell, like here's a product that's adjacent but not too far away that your existing team could sell it, that seems to be the biggest win. What about the geographies, like going international? Like when did you start doing that? And
we did that in 2008. We sent some folks over to the UK to help open that market, and we hired a managing director who's still with us today, and it's fantastic.
You went organic. You just started building an office, setting up shop there.
Yep.
When did it come to the point to say, hey, we should accelerate international with M&A?
When we wanted to go into mainland Europe, we found a business called Connexus in the Netherlands. And so we acquired that business. We acquired two other businesses in the Netherlands, as I mentioned, TextKernel being the most recent. And so now we have a big presence in the Netherlands.
Fun and easy?
No. Doing business in Europe is very different than doing business in the United States. For instance, they have something called the Works Council. You can't just roll in and say, hey, we're going to make these changes to these salespeople are going to have a different territory. Well, time out. There's a Works Council that you have to go before. It's made up of employees, and you have to talk to them about any sort of personnel changes you want to make or any changes to sales territory or compensation plans. So it's much more complicated. Regulatory scrutiny on businesses is much higher. Even privacy, all that stuff, very difficult. So, but why do businesses do it? Because you can still generate an incredible revenue stream and income and profits, and it's great, but it's hard. It's different, especially for Americans who are not used to that kind of like
don't do
regulatory
it for,
environment.
Don't do it for an ego. Have a good business case. That's like a whole topic we can cover.
For sure.
That. Just to wrap, I know we're getting on time here. I want to go back just to I was curious about the real early part, because a lot of these are M&A deals or relationships. Even that one example when you did the first acquisition, 2 companies at once, that's a lot of conversations. I wanted to get an understanding of how do you approach it? Is it you have team members in-house that are really facilitating these early conversations? What's your approach?
So I mentioned the MD who opened up UK for us. He now runs corporate development. And his superpower is, well, he loves deals. He really loves deals. But his superpower is building a bond and a connection with the selling CEO, whether it's a founder or CEO that's been brought in by investors. He's really good at understanding what they're trying to achieve and what they want out of a deal. Not just the financing. Like a lot of times it is just about like, you need to hit my number and I don't care and I'm a mercenary. We see that. But we also see CEOs who really care about their product or their people or other things. And you have to navigate that. And you have to, okay, what are you trying to achieve? Some CEOs, they care about a press release and how's it going to look? And you have to understand that psyche and get inside their head and say, okay, if I were them, what would I want and how would I want? And Pete's very good at that. And our whole corp dev team does a lot of that actually, and trying to understand seller motivations.
You guys all are from London?
Yeah, London, yeah. And our SVP at corp dev also is in London. So yeah, we have a London-based, maybe it's like the British accent thing helps. I don't know.
Maybe, but you're still doing a lot of domestic deals.
We are, yeah.
Like fly back and forth. I feel like you'd have to face-to-face to really get that kind of rapport and understanding of somebody.
You do. You have to do some fair amount of face-to-face. Yeah.
So that's the key thing is build a relationship and really understand what's the motivator and drivers.
Yeah.
What's the craziest thing you see in M&A, Art?
I think the craziest thing was during the pandemic, during lockdown, I was having conversations with the team from Stone Point about, hey, when we get out of lockdown and things open up and COVID's behind us, we should do a deal. And at one point they said, you know what? I think now is the time to do a deal. And this was like August of 2020. Wow. When the world was really not like recovered by any stretch. And it was a big deal. Like that was a very, I would say like for a firm, Stone Point Capital is not thought of as like risk taking. That was a very bold move. And to Jared Levine's credit at Stone Point, I think he approached that at just the right time in August of 2020. And he approached us and we said, okay, if you hit this price, we will sell you the business. Now, in our view, the business was uncertain because we didn't know whether or not the staffing industry was going to shoot out of this thing into growth or have another period of lockdown in December. And we talked about like, if there's another lockdown in December, that will be harmful to our customers. And so maybe there's some risk here and maybe it's a good idea. Now, may not be the highest price we could possibly get if things take off, but it seems like a good risk-adjusted price. Sure enough, things took off, and but we did the deal, and it actually worked out really, really well for Stone Point. And they were the beneficiaries of the fact that the staffing industry had this like huge growth spurt coming out of 2020 into 21 and 22, and continued into 23. We did really, really well, and Stone Point is really happy they did the deal when they did. Now, Insight and Genstar, might have had some hindsight of like, well, if we had waited 6 months, we probably could have sold for even more. But they also didn't know whether or not there was going to be another lockdown. And okay, they rolled some equity into Stone Point's deal, which allows them to feel good about the equity they maintained and retained. And so I thought that was crazy. Like, we couldn't believe it. We kept saying, like, is this guy for real?
Wow.
Like, we're in the middle of lockdown.
Yeah.
And we're doing a deal over Zoom. I haven't even met his partners in person. I haven't seen my own team in 6 months. This is nuts. We didn't even have a closing dinner because nobody was getting dinner at that time. Like, people were still terrified. I mean, there's the whole nother conversation about lockdown policies and how stupid we all were back then, but and what we did to kids not going to school and all that crazy stuff.
Wearing
but
a mask all day in school.
Yeah, like 6 feet apart.
Yeah,
how'd they come up with that? Oh, we just made it up. But I think it was like you got to give Jared credit at Stone Point for like leaning in and being like, okay, I believe. I want to own this company. The price might seem a little aggressive at the time, but in hindsight, it really worked out.
Yeah, it's doing deals during turbulent times.
Yeah, it was great. We all thought it was crazy. None of us could believe it when it finally closed. We were still like, did that actually happen? And how can we celebrate? We can't really even celebrate.
Zoom cheers.
Yeah, Zoom cheers is lame.
I know.
Yeah.
That was the lamest thing.
Yeah.
All right, this has been a great conversation. I learned a lot. You've helped me become a better M&A scientist.
I really enjoyed it. Thanks for having me.
Those of you still listening, fellow M&A scientists, I appreciate you. Always welcome feedback, criticism. I learned a lot from criticism. Reach out to me on LinkedIn, topic ideas, other things that we could do to improve. Till next time, here's to the deal.